Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted again to be able to speak to Jerry Randall, CEO of Venture Life, a leading OTC consumer healthcare products business. So welcome, Jerry.
Hi, Paul. Yeah, good to see you again.
Yeah, well, big congrats on this morning's excellent trading update with Q4 sales up 59% to around 11.5 million, as I calculate it, compared to Q3 around about sort of 7.2 million pounds. You've had a massive increase just recently over the last, particularly the last quarter. Can you just walk us through what's been driving that terrific growth?
Yeah, I think it's quite important to look particularly at the half. I know we've mentioned obviously the quarters, but obviously over 18 million in the second half of the year. And what's pushed it towards the second quarter is partly specific timing of sales, but also this whole issue with logistics and shipments. So stuff was just taking longer to get trucks available and ship stuff. So there was some stuff that shipped in the fourth quarter that ordinarily might have shipped in the third quarter. That's right. Not a big part of it, but that is part of it. The main bit is a lot of growth in the business on what we call the sort of customer partner brands part of the business. So that's where it's all made to order. People place their orders, we manufacture them, we deliver it to them, and that part of the business is growing really well, particularly with BBI coming online, because they've got Bayer as a big partner and a number of other partners selling the women's intimate health product, and they've had big orders going through in that quarter. So it's really the pickup of that business. BBI, Helston as well has had a really strong quarter four. Again, once we got a hold of the business and started getting orders pushed into that. So it's really that momentum of the business that we've acquired, and the underlying business has sort of carried on sort of where it was from before. So most of that impact of revenues come from the acquisitions, obviously.
And what's the order book looking into 2022 now? Then, I mean, is this sort of trend, this run rate, this half sort of sustainable?
Yeah, absolutely. I mean, I think you should look at the second half of the year as being a bit more as we stand today, what a normal run rate is. And I think analysts, when they put their figures out just before Christmas, they picked on figures which, if you effectively take second half of this year and you double it, put a little bit of organic growth on it, you're going to be ending up where the analysts are. So very achievable, and it's all the consolidation of those acquired businesses and the trading from the underlying legacy business.
Right, okay. And that's sort of the trend you had at sort of the middle of last year with the de-stocking. Has that now sort of run its course, has it?
We think so, yeah, because it's kind of switched back the other way, because it was as I say, we saw flat sales effectively on the legacy business in the second half of the year, and that's because we had that de-stocking during the year, but we think that's run its course. We think people are back to normal ordering patterns. We think what will happen as we go further into the year is we'll be encouraging people to order further ahead. So you're not really seeing a lot of that impact already in the order book, but as we go through the year, not pulling sales to different months, but ordering further out because of the uncertainty regarding the supply chain, because the issue now seems more around the timing than the price. We've had price increases and we've absorbed those, and we're now putting our customer price increases through. But the lead times for supply, particularly packaging things with paper and card, is out to 3, 4, 5 months. So we're starting to encourage customers to order further ahead than they ordinarily would. So typically they'll order 3 months ahead. We're encouraging them to order 4 or 5 months ahead to make sure we don't have any issues. What's happening in the paper and card part of the business, because they're virtually all of their costs of manufacture are energy, the sort of raw components are quite cheap, with the energy prices rising so high. A lot of them at the moment are making product at an actual loss if they manufacture the product. So what some of them have done is to say, well, we're going to stop making packaging and paper now. We're going to wait till the warmer weather, energy prices come down, and then we can start making again at a profitable in a profitable way. So it means the supply of card and paper has become a lot shorter in this first quarter of the year and normal. And I think it will go into the second quarter. So we're ordering well ahead, because there are people still making it, but there's less people making it. So it's a shortage of supply. So we're making sure, we're getting customers to acknowledge that and order earlier to make sure that they can have their orders. So we're not pulling sales back. We'll still land where we expect to land. But ultimately, it will give us a longer horizon on our visibility in the order book, which will be, a good thing for us.
Yeah. I mean, another feature also from today's trading update was you're in line with analyst expectations on the EBITDA side, which means that you must have had the margins must have picked up considerably in the second half compared to the the first half, and I sort of calculate. I think you hit 30, about just south of 13, or just south of 14% EBITDA in the first half, which means that you hit probably just over 23% in the second half to get round about sort of analyst expectations. Can you talk through that? I mean, that's a 9% swing between H2, H1. What's driving that? Is it mix? Is it basically what is it?
Yeah, sure. It's a combination of mix and the acquisitions that we made, because both of the acquisitions we made in the summer had much higher gross margins than our legacy business. So you've got them coming in and substantially adding. So that's a significant part. But also overall volumes, as we sell, greater volumes through our business with a fixed cost base, we're getting an improvement of that bottom line, because even though gross margins are improving through the acquisitions, and we're starting to put customer price increases through, so that's helping gross margin as well. But because of that fixed cost base, that incremental gross margins substantially dropping through to the bottom line. So you'll expect to see the gross margin that we've hit in the second half. You'll expect to see that going forward, and obviously that's given a significant boost to the EBITDA margin in the second half of the year.
Right. Ultimately, once we're through this sort of like, the COVID transition, and prices have normalized, to make sure you've absorbed, when you've fully absorbed the costs. What sort of like EBITDA margins sustainably are you looking at? If to say they're currently around about 23%, what are you looking for?
Yeah, I mean, we think that 25% is our target over short to medium term, and we think that's achievable. I think we'd have been on track for that if it wasn't for the price increases that came through for COVID. So next year we'll be coming above 20% and starting to move towards that target of 25. And I think that's probably, in the state we are, the shape we are, the structure of our model, that's achievable. I think as we start to, if we increase the brand's presence more and more, and the brand's having more and more margin, then ultimately we could probably look to move beyond that 25%. But that's our sort of short to medium term target.
Yeah, and then the sort of the net debt position. I mean, you just talk us through that one, because I mean it's a small sort of like 3.2 million net debt position, but it's what's sort of driven that as, in the second half?
Yeah, so because we had such a big sort of fourth quarter, particularly in November and December, we've had a bigger draw on working capital than normal, and so we'd expected that net debt to come down a little bit more, but it's actually all sat in receivables at the moment.
Yeah,
so through January and February, there'll be a big receipt of incoming receivables from that, which will take it back down, lower than the 3 million point.
Okay, and then you've got some sort of lovely little opportunity, or big opportunities potentially. First of all, let's go for the China. You've started making first deliveries of the oral or mouthwash products to your distributor there, the new one, Samarkand.
Yes.
Can you just talk about ultimately how big do you think that particular China opportunity could become?
Yeah, sure. I mean, as you saw, sort of in our history, we've had good sales into China before, and in 2020, when we last had sort of meaningful sales into China, they were running at the sort of £2.5 million pounds a year. So we think it's we should get to that level again in the not too distant future. I mean, I think this year would be optimistic, but I think in 23 and 24 we should be at that sort of level reasonably quickly. And I think it will depend what else they do in terms of other products and starting to roll out. So certainly on the products they've taken, we'd expect 2 to 3 million a year revenue. I mean, this year their forecasts are in 7 digits. The minimum purchase and their forecasts are in 7 digits. So there should be reasonable numbers this year. But that would be my sort of aim: 2 to 3 million over the next 2-3 years. We should be able to reach with them. And then if they add more products, it will increase from there.
And then the other opportunity, well, seems to be the supplying products under sort of large chain type of brands. Can you talk through that one? Because sort of like, what's the scale of the opportunity? What's the sort of the strategic rationale, and how do you see that sort of like developing?
Yeah, so what we've got, obviously a number of products outside our main brands, and so what we like to do with those is to put those through on an own label basis with those larger retailers, because we want the retailers to stock our main brands, so the likes of Balance Active, the likes of Dental, and Lift and such like. But we have smaller products. We have products that came out of the Pharma Source acquisition, In 2020, some smaller women's health products. The rosacea product is a product we developed ourselves. So we're very happy to do those on a white label basis because we're not building brands around those products. They're just other products we have in the portfolio that we're very happy to white label with those big retailers. Strengthens the relationship and also, you know, builds revenue for us. But on our main brands, we'll be making sure that we stick to them taking the branded product, not an own label product.
So you won't be giving them sort of like an own label for Balance Active, you're saying? You're giving them for an... Oh, okay, gotcha.
Yeah, this is for... It's a women's health product, but it's a different product from Balance Active. It's just another smaller product we have in the portfolio.
Yeah.
We're sort of circumspect about what we say about it because obviously they want to launch it and do all their things. So we can refer to it in the generic, but we don't give too much detail on it for their commercial sensitivity, really.
Okay, and then what about the Pommy Tea product that seems to be? It came from I think it was the Helsing acquisition, was it last year?
Yeah, it is. Yeah, and in the portfolio we bought, it was whilst the younger product per se in terms of market, it was the bigger product by revenue. It's only on sale in 5 markets in Europe at the moment. And if you look at the UK alone, there's 1.2 million people with prostate cancer at any one time, and obviously you multiply that across the European markets. And you look at our product, even if we got 10% of that, if we had 100,000 people taking our products, each year, and it's £7 for a monthly dose. So you can see the numbers get quite big very quickly. There are other products out in the market. So saw palmetto is a classic sort of vitamin or herbal that people take. But again, there's no real sort of strong clinical data behind it. But if you look at Pommy Tea, it's got over 200 patient double-blinded clinical study showing the benefits for patients suffering with prostate cancer. And as a really high antioxidant kind of product, it also has applications in other areas. And we're looking at that, for example, in women's health and other areas where we may launch the product as well. So yeah, it could be, even on those numbers, if we had 100,000 people, taking our products a year in the UK, you're talking, millions here in the UK, and then you roll it out to other major markets, could be very big. So we're very excited about that. And it's quite sort of unique as a product in its space.
Okay, great. And then sort of just with those, you mentioned it earlier, just the price increases you're putting through, how's that been absorbed by your sort of like your customers, and how, are they sticking the ones you put in, and are you optimistic about recovering all of effectively the margin loss you've had through the supply chain?
Yes, we will. And customers on the whole are understanding, of course. The first response from a customer is always no.
Yeah.
But then ultimately there comes a point where they need stock. And therefore, if they need stock and that's the price, that's what they have to pay. So where we supply into retailers, there tends to be a little sort of transition, where they're sort of saying, well, we don't really want it. And you say, well, that's the price. It's the same for everybody. And, then obviously when they come to needing stock, they'll, see what they want to do and hopefully move ahead. So for a number of retailers, we've already gone through that phase. For others who've had a lot of stock, they're now going through that phase. For the international partners, they will understand. We've got provisions in all of our agreements to be able to increase the price when cost of goods goes up. Newer agreements where we signed them in the last 12 months, we have to wait another 12 months before we can do it. But on the whole, we've been able to do that. We did an increase in the summer last year. We're doing another increase now. So yeah, we're confident that over the sort of 12 to 18 months we'll pick up the loss in cost of goods that we've got, and we've assumed in that there's no reduction in those supply prices. So ultimately, supply prices come down, which I think they will. When the supply chain frees up a bit, we'll get an additional benefit from having the prices at a certain level, and we should start to get some benefits on cost of goods.
And what's your availability of sort of product nowadays in terms of you just getting? You mentioned you're still seeing some of the raw material shortages and cardboard and short lead times and all this sort of stuff. What's your sort of like visibility of being able to actually deliver the product?
Yeah, so if you look, about 25% of our business goes straight into retailers, and so we're still carrying quite a high level of inventory. We're carrying sort of between 4 and 6 months of inventory. Right. For products to make sure of that, because we built it up for Brexit in at the end of 2019, and then of course COVID came as well, and then Brexit was delayed, and we built it up for COVID, and we built up for Brexit. So we've held that quite high level of inventory. And I suppose at the start of 21, we were hoping that would unwind a bit in 2021, but of course COVID remained and these issues remained, so it's kind of kept up there. So we're still carrying a higher level of inventory of those finished goods that we sell. And the other 75 of the business that's made to orders, other 75%, excuse me, then we're just encouraging customers to order a bit further out to make sure that we can, get the lead time. So all the customers have been informed. They know lead times now, and that's their decision. But so far, they're all saying yes, we understand, we'll order earlier, and that process is beginning now.
Fantastic. Okay, then what's the sort of, just finally, then what's the news flow going forward? Is it prelims at the end of March and early April?
Yeah, that's right. End of March will be the full prelims. You'll see more deals being done on our products in the meantime, and we'll update that. Of course, as you know, we continue to look at M&A, and we're active in that area. So, you can expect to see some things on that going forward. So,
and what sort of like, just on that M&A, what sort of like, just remind investors of the funding capacity you have for types of deals.
Yeah, so we have a £50 million revolving credit facility, an initial 30 plus an extension for another 20 under the same terms. And that's just linked to 2.5 times our trailing EBITDA, including what we buy.
Yeah, okay.
So, if we have EBITDA of, simple, 10, then it would be 25 availability at that point. We've got obviously some drawn because we've got a bit of net debt at the moment. And obviously, if you generate cash, that takes that sort of net facility down. So we've got, as I say, up to 30 to draw. We've drawn about 7 or 8 at the moment. So we've got another 20 or so we can draw, subject to the EBITDA criteria, and then another 20 beyond that once we've used that up. So plenty there for nice additional earnings enhancing, immediately earnings enhancing, accretive acquisitions, nice products that fit into the portfolio and broaden those key areas of women's health, diabetes, and oral care that we're in.
Brilliant. Okay. Well, again, I would highlight to investors, have a look at Venture Life, because the shares at currently just like south of 40p are trading on less than or around about 6.5 times EBITDA. And most OTC consumer healthcare products companies are trade at sort of 15 times plus EBITDA. So it's massively good value on offer. And I know Simon Thompson, a super smart investor at Investors Chronicle, has got a sort of £1 price target, and I think was it Senkos previously have got a upside scenario of £1.27. So plenty of upside if you and the management team can deliver there, Jerry.
Yeah, well, we're very confident. The year started really well. We're really pleased to get the 21 numbers under our belt, and we're feeling very positive about this year.
Fantastic. All right, well, look forward in touching base again in a couple of months' time. Thanks, Jerry.
Great. Thanks for your time, Paul. Thanks. Bye-bye. Bye.